Alright, welcome to another video. In this one we're going to be looking again at the weekly macro themes report. It's from a couple of weeks ago. This is the one that goes out to clients, and we are going to be looking at topic number 4. Topics. So this one is Japanese equities, and there's one very interesting discussion here actually. So let's just go straight into it. All the way down to here, 4. So just for a little bit of clarity, topics there, the Japanese benchmark, well, what the key other benchmark other than the Nikkei 225. Bottom line is, and this is a good sort of insight into the format of these reports, by the way, bit of a text and discussion, which is followed by, really much a focus on charts, data, signals, and indicators. And across the spectrum too, so you can see there hardcore fundamentals, earnings, economics, a bit of intermarket analysis there, and a bit on the currency. But anyway, into the bottom line, with an explosive equity risk premium, solid earnings momentum, Japanese equities might make a break from the shackles of the USDJPY. And that is very important for reasons that I'll have a look at. So, first one is talking about this equity risk premium that I mentioned there, the ERP. Black line in this chart on the left, shows you the earnings yield, which is, really just tracking around where it has been for the last, I guess, about a decade. So it's about 7% at the moment, 7%. Then you look at the 10-year government bond yield there, it's basically nothing. So the equity risk premium, if you're comparing it, or the earnings yield, the bond yield spread, something that we commonly look at for the US market, it's about 7% there, which is substantial. And then, if you wanted to take a little bit of an alternative look, the shadow policy rate, so that is the Bank of Japan official interest rate, adjusted for the impact of quantitative easing, that's at almost negative 8%, so that would give you a earnings yield to policy rate spread of about 15%, which, is exactly as I said at the start, explosive, compelling. So one thing though is worth noting, and that's this whole relationship between valuations and bond yields. So, it makes intuitive sense that bond yields, risk-free rate, whatever, yields in general should be influencing valuations. If you think about your standard discount cash flow model, one of the key inputs there is what you're discounting it by. So, and the discount rate that you're going to be using is going to be impacted by the risk-free rate input, and it's got to be feeding off something similar to the bond, the 10-year government bond yield. But anyway, this chart on the right here shows how three key indicators for Japan have been evolving over a reasonably long period here. So you got the forward PE ratio, i.e. valuations. You got the 10-year government bond yield, which will say, has an impact on your discount rate. And then you've got the real GDP 10-year compound annual growth rate. And really this kind of lays it bare. So you've gone from this period here where the forward PE ratio for Japan was habitually in this 30 to 50, mid-range double digits, even got up to 70 at the peak. And, you'd kind of think it would go in the opposite, because now you've got much lower bond yields and much lower valuations. They've really gotten over 20 in the last sort of 10 to 15 years. And a big driver of that is the fact that growth has been very much poor. And so, yes, a lower bond yield should be feeding into higher valuations, but if the growth rate of the cash flows in that model, that valuation concept, is lower, then the overall product is going to be lower as well. And so we've kind of basically seen that here. But it doesn't mean that it's not valid to think about an equity risk premium, because it's, you know, it's essentially what the investor is weighing up. I mean, the domestic constrained investor in Japan is weighing up getting nothing from bonds, or this 7% earnings yield in equities. So I mean, that is a thing. And even despite the fact that you've got that lower growth, it's still a relevant factor. So I'd say that basically that's still an important background piece of information, notwithstanding this very important chart here, which I think is important because the issue is talked about in a lot of different markets. But moving on to a more cyclical picture, I guess that these two charts, certainly the one on the right, is more of a secular or structural picture. These two here give you very much the cyclical picture, and you can see there that the earnings revision indicator that is in the red, that's a combination of the change in forward earnings and the earnings revisions ratio, the ratio of upgrades to downgrades. And then you've got the year-on-year change in forward earnings there. So you can see there that there's been a clear upturn after that micro recession in 2015-16. And that's, in many ways mirroring what's going on with the economics there. You can see that economic confidence picture combines just about pretty much every confidence indicator I could find for that country. And it shows it running at a pretty strong level, so cyclically the picture is pretty good there. And when the cyclical picture looks very good, you always want to start raising questions about whether, or you want to examine whether it's a good cyclical signal, i.e. the cycle's improving, or a bad cyclical signal, which is things are looking good, but they're looking too good because the cycle is maturing. I don't think that is the right assessment for Japan at this stage. It's still looking, later stage recovery, but still early stage of that latter phase of the cycle. So bottom line there is that the earnings cyclical and macroeconomic cyclical, status for Japan is pretty good. So we're starting to build a fairly interesting picture there, that compelling equity risk premium and cyclical macroeconomic and earnings picture there. And that brings you to the last set of charts, because the currency is really a key input for Japan. A change, I mean, in many ways what Abenomics did was mobilize the currency to drive, a cyclical impulse there, and it was pretty successful in the initial stages. And if you look at the way that the TOPIX trades against the USDJPY exchange rate, it's almost lockstep. There was a brief divergence in 09, and I think that we can probably figure out the reasons why for that pretty easily. But if you look at it lately, there has been another divergence opening up, and I guess I've sort of posed the question as to whether this is, the time for a change, whether the Japanese equities can decouple from the currency. And the reason, one of the key reasons why they tend to track fairly closely to the currency is because if you get a weaker Japanese yen, that's good for Japanese corporates because they have a lot of earnings offshore. And so I guess then you need to understand the predominant sort of picture for what's going on in the currency there. Now, what we've got here is a few different things. So the black line there is a valuation measure, and you can see there that when Abenomics launched and smashed the currency, really weakened it in a big way. It was actually pretty overvalued, so, from a timing standpoint, they got it right. But, if you look at where it is now, you've pretty much got the opposite conditions. So, the other thing to think about there is this speculative futures positioning, and that is basically the net speculative futures contracts standardized by open interest. So it's a measure of sentiment, really. And, if you looked at that time just prior to the, where it really took off, you had overvaluation and a crowded long. Whereas now you've got the yen looking relatively undervalued and as a reasonably crowded short as well. And I guess the other thing to note, in passing on that one, you go back to that chart of the shadow policy rate. When you're that far into the ground, I mean, yes, you can go further, and if you do go further, the rate of change on that is going to be smaller. The odds are that it goes higher from there. And, certainly if you're looking at the cyclical backdrop there, kind of lines up with that. So if this, ends up playing through in the actual currency, coming from undervalued and crowded short, the odds are that it strengthens from here. So, could have another attack down towards that 100 level. And you look back at this TOPIX versus the currency chart. So it would mean that red line coming down towards, this level here, which would be, in the past consistent with the TOPIX level of about 1200. So that's going to be a really big test for Japanese equities, and I'm actually not sure whether they do manage to break that correlation there. I mean, when you have got that compelling equity risk premium in the background working for you, and the pretty compelling economic confidence cyclical picture there, it definitely puts things in its favor. But the jury's out on this one, and time is going to tell. I guess the other things to think about is what's going on in Japan's major trading partners. So China's looking a bit better at the moment, and global trade is looking pretty good too. Global growth looking fairly strong. So, if there was a time where it could decouple, at least temporarily, medium term at least, I think that this would be actually, ripe conditions for that. And I guess there's also an element of, monetary policy is probably done as much as it can do at this point, and it's over to fiscal policy, and the shape of what that may look like will become clearer in the coming weeks as their election progresses. So a lot of interesting issues to talk about with Japan, both on the currency side and on the equity side, and very interesting sort of interrelationship here on the long-term chart of P ratio, bond yields and GDP growth, one that's very relevant to very similar discussions that are going on in other markets, for example in America. So look, I'm going to leave it there, and if you've got any questions or comments about this video, please go ahead and leave them in the comments section. And if you like this, if it resonated at all, just go ahead and subscribe to the channel. That'll help you follow, on for any future videos that we do on this.